If you own property in the United States, one expense quietly decides whether that property builds long-term wealth or slowly drains it. Property tax is not small. It shows up every year, it keeps increasing, and it never asks whether your income went up or not. Many people focus on price appreciation and rental income, yet the real difference between stable property ownership and financial pressure often comes down to where the property is located. State policy shapes how much of your cash stays with you after ownership costs are paid. This is why serious property buyers study property tax rules before they ever look at listing photos. In the U.S., property tax is controlled at the state and local level. There is no single national system. Each state sets its own framework, then counties and cities apply their own rates within that framework. This creates major differences across the country. Two identical homes with the same market value can produce very different yearly tax bills simply because they sit in different states. This difference compounds over time. Over 10 or 20 years, it can equal the purchase price of a second property. Property tax savings do not come from shortcuts or loopholes. They come from understanding how states structure assessments, caps, exemptions, and valuation methods. Some states keep tax rates low by design. Some limit how fast assessed value can rise. Some reduce tax exposure for owner-occupied homes. Some shift tax burden away from residential property toward other revenue sources. These systems are written into law and used by millions of homeowners every year. Among the strongest states for property tax efficiency is Hawaii. Despite high home prices, Hawaii maintains one of the lowest effective property tax rates in the country. Local governments rely less on residential property taxes and more on other revenue streams. For owners who hold property long-term, the annual tax burden stays relatively controlled compared to property value. This matters for people focused on preservation of capital rather than quick flipping. Alabama is another state that consistently ranks well for property tax savings. Assessment ratios are low, and residential property is taxed at a smaller percentage of market value. This structure reduces annual holding costs. For rental property owners, lower taxes improve cash stability. For homeowners, it reduces long-term cost pressure without requiring special exemptions or complicated filings. Colorado operates on a system where residential property is assessed at a lower percentage than many other states. While market prices can rise quickly in some areas, the tax structure limits the direct hit on owners. This creates balance between local government funding and property owner sustainability. Investors who plan to hold property across market cycles often prefer systems like this. South Carolina uses assessment classifications that keep owner-occupied homes taxed at a lower rate. This policy supports long-term residency and discourages forced turnover due to rising taxes. Property owners who understand classification rules can plan purchases accordingly and avoid unnecessary tax exposure. Utah stands out for consistency. Property taxes remain moderate, and assessment practices are generally stable. Large spikes are less common, which allows owners to forecast expenses accurately. Predictability is an underrated advantage in property ownership. It allows better budgeting and protects cash flow during market shifts. Nevada limits how much assessed value can increase each year, even when market prices rise sharply. This cap protects existing owners from sudden tax shocks. For long-term holders, this system can dramatically reduce cumulative tax paid over time. The benefit grows the longer the property is held. Tennessee does not rely heavily on property taxes compared to many other states. Assessment rates and overall tax burden remain manageable. This attracts both homeowners and rental property owners who want lower fixed expenses without complex compliance requirements. Indiana applies property tax caps that limit tax as a percentage of assessed value. This creates a ceiling on annual property tax liability. Owners benefit from built-in protection regardless of market movement. These caps are applied automatically and do not require advanced planning. Wyoming combines low property tax rates with minimal assessment pressure. Population size and alternative revenue sources allow the state to keep property taxes restrained. For owners focused on long-term holding rather than rapid turnover, this structure preserves value efficiently. Louisiana offers homestead protections that significantly reduce taxable value for primary residences. While not all properties qualify, those that do experience meaningful savings. The key is understanding eligibility rules before purchasing. Property tax efficiency is not about avoiding responsibility. It is about aligning ownership with systems that respect long-term stability. Every dollar saved on recurring taxes strengthens ownership position, improves resilience, and increases flexibility. Smart property decisions start with understanding how states treat owners after the purchase is complete. Choosing a state for property tax savings requires more than looking at a ranking list. Real value comes from understanding how laws operate year after year. Property tax systems reward patience, consistency, and informed ownership. When buyers ignore this, they often experience rising costs that slowly erode returns and personal security. In the United States, property taxes fund local services such as schools, roads, and emergency services. States choose different ways to distribute this responsibility. Some spread the burden evenly. Some protect residents. Some place more weight on commercial property or transaction-based revenue. These choices shape the long-term experience of property ownership. One important factor is assessment frequency. Some states reassess property annually. Others reassess every few years. Less frequent reassessment can slow the pace of tax increases. Owners benefit from stability even when market prices rise quickly. States that combine longer reassessment cycles with caps provide an additional layer of protection. Assessment methodology also matters. Market value assessments track sale prices closely. Other systems rely on formulas that smooth fluctuations. Formula-based systems tend to reduce volatility. This benefits owners during rapid appreciation periods. Understanding which system a state uses helps buyers anticipate future tax exposure. Another key factor is exemptions. Many states offer reductions for owner-occupied homes, seniors, veterans, or long-term residents. These exemptions lower taxable value rather than tax rate. This distinction matters because reduced value compounds savings over time. States that automatically apply exemptions reduce administrative burden and error risk. Tax caps offer structural protection. Caps limit how much tax can increase annually regardless of market movement. This design supports aging homeowners and long-term holders. Without caps, owners may face rising taxes that force sales, even when property value increases on paper only. Local variation must also be considered. Even in tax-efficient states, certain counties or cities may impose higher rates. Smart buyers analyze both state framework and local application. A low-tax state with a high-tax county can erase expected savings. Research at the county assessor level is essential. Property type influences tax outcomes. Owner-occupied homes often receive the strongest protections. Rental properties may face higher assessment ratios or fewer exemptions. Investors who understand this difference structure their portfolios accordingly. Long-term planning includes matching property type to state incentives. Economic structure of a state affects tax policy. States with diverse revenue sources rely less on property taxes. Tourism, energy, manufacturing, and service economies contribute alternative income streams. This allows property taxes to remain lower without underfunding services. Population trends also matter. States with steady growth manage tax bases more smoothly. Rapid population loss can increase pressure on remaining property owners. Stable or growing states with disciplined fiscal management offer better long-term outcomes for owners. Legal transparency is another indicator. States with clear assessment appeals. Processes give owners tools to correct overvaluation. Accessible appeal systems protect owners from inflated assessments. This is a practical safeguard that reduces overpayment risk. Holding period amplifies savings. Small annual differences become significant over time. A 1% difference in effective tax rate may seem minor initially. Over 20 years, it can exceed tens of thousands of dollars. Long-term thinkers focus on cumulative impact rather than yearly comparison alone. Property tax planning should begin before purchase. Buyers often focus on mortgage payments and maintenance while ignoring taxes. This creates surprise costs later. Informed buyers factor tax trajectory into affordability calculations. This prevents stress and forced decisions. Relocation strategies also play a role. Some owners move primary residence to tax-efficient states, while maintaining investment properties elsewhere. Others concentrate portfolios in states with predictable tax systems. These decisions are legal and widely practiced. Documentation accuracy protects owners. Incorrect property classification or outdated records can increase tax bills unnecessarily. Regular review of assessment notices ensures accuracy. Many overpayments occur simply due to unchecked errors. Understanding legislative trends matters. States periodically adjust tax laws. Owners who follow local policy discussions anticipate changes early. This awareness allows proactive decisions rather than reactive responses. Professional guidance at the local level adds value. County assessors, tax consultants, and real estate professionals provide insight into specific jurisdictions. This ground-level knowledge complements state-level research. The goal of property tax efficiency is sustainability. Ownership should support stability, not create hidden pressure. States that respect long-term ownership allow individuals and families to plan confidently. This confidence translates into better financial behavior and stronger communities. Property tax savings achieved through informed location choice represent one of the cleanest forms of financial efficiency. No speculation is required. No aggressive strategy is needed. The benefit comes from alignment with systems already in place. When evaluating property opportunities, serious buyers treat tax structure as foundational. Price, rent, and appreciation matter, but recurring costs define long-term outcome. States that manage property taxation responsibly create environments where ownership remains viable across generations. Understanding where to buy is as important as knowing what to buy. The best property decisions consider the rules that apply after closing day. Those rules determine whether ownership feels manageable or restrictive over time. Informed property ownership in the United States rewards preparation. States with favorable property tax systems provide a stable base for long-term planning. This stability allows owners to focus on productive goals rather than constant adjustment. Property tax savings are earned through awareness, not avoidance. They reflect alignment with legal frameworks designed to balance public funding and private ownership. Choosing the right state is one of the most effective decisions a property owner can make.